was plenty in it, and we'll try and get through the main bits that we can do in the time that we've got. There will be time for questions later on, so we will answer those as quickly as we can. So, as always, we have our usual disclaimer. So, the following presentation is produced for general guidance only. Professional advice should always be sought before any transaction is undertaken, and individual circumstances can vary, and therefore no responsibility can be accepted by Harts Limited or any of their affiliates for any action taken or any decision made to refrain from action by attendees of this presentation. Please bear in mind there are lots of other online resources available to you. So you can follow us on LinkedIn. We'd love you to follow us. We're trying to get our followers up, so that'd be great. Likewise, we have a number of webinars and old webinars and videos and so on YouTube. So feel free to go to our YouTube channel. You just need to search for Harts Limited. You can also follow us on X, and we have some podcasts on there as well. And likewise on Spotify, rather, where the podcasts are. X, we put out regular information on there as well. But Spotify, we do have some podcasts on there. There will be some more coming later on next year now. So have a look out for some of those. The next webinars and events on the 20th of November. So that's at our usual business club lunch. And that is at Hollin Hall Hotel in Bollington. And that is in association with the North Cheshire Chamber of Commerce and Orbit Development. If you want to join us for the pre-Christmas lunch, that'll be much appreciated. We normally get 50, 60 people there, so it's well worth coming along and doing some networking there as well. And our next webinar, our final webinar for this year, is on the 27th of November. Now, we've got the change in government. We've also now got a change in government in the States, but that's not going to affect us immediately, hopefully. But on the 27th of November, we've got MFA from HR Department Wilmslow, and she's going to update us on the new employment laws which the new government have brought in. So how that's going to affect you and how that's going to affect your business. So it's well worth booking on that. They can all be booked on from the events page on our website at harts-ltd.com. So that's all you're going to get from me. Just a reminder that those clients who are on this call and you've not sent in your information for your self-assessment returns yet, please can you do it as soon as possible, because we want to kind of avoid the January rush. So if you can send that in as soon as you can, that will be much appreciated. So Chris, it's over to you.
Thank you very much, Stephen. I think what's important to say on this one is the legislation is draft at the moment. There are some big changes. Don't rush into doing something. Reflect. There are big changes. Yes, expectation with the size of the government's majority is that it passes through substantially unchanged, because there's no one really to put up much opposition to it. But think where you want to get to, particularly capital gains tax, inheritance tax, pensions. It's definitely reflect before taking any action as a consequence of the changes. Most of those changes have got a lead time of several months, if not a couple of years. So anyway, the key themes coming out of the budget is increased government spending, and businesses and business owners are getting the bill for that. So, or at least initially. So the first big change, employer national insurance is up significantly from April 2025. That's not so much the 1.2% on the rate. Yes, that's decidedly unhelpful, but actually the cut in the threshold as to where employer national insurance kicks in is a much bigger effect for many businesses. We'll do some examples on that later. You've also got above inflation increases to the minimum wage coming. They're about 6 to 7% for most staff. Inflation's currently running at 2 thereabouts. Capital gains tax. If you want to sell your business or any other assets, then the tax rate's already gone up. Or if you've got business asset disposal relief, it's going up shortly. Residential property gains aren't affected by the immediate tax rise. What they've done is they've equalised rates with the higher rates already applying to those gains. Inheritance tax reliefs. Should you die, either because of you're old or unexpectedly, roll forward 18 months, there may well be an inheritance tax bill on your estate where there wasn't previously. We've got to think about how your business might cope with an unexpected tax liability. Could it survive? Could it continue? For many years, people have put money into pensions, often as part of an inheritance tax shelter. The government's announced that that will cease to work from 2027. And when you actually look back to it, there's an element of retrospection about it. And on the personal tax side, it's an ongoing freeze on income tax allowances, which we knew already. And there's no tax change to income tax rates or allowances, including for dividends. And I suspect that is perhaps the one bright spark that many people will see in this budget, many business owners at least will see in this budget, that at least they haven't yet put the tax rate up on dividends. So I'm going to start by looking at the impact for businesses this time around. I know it's traditional to look at personal tax first, but I think given the changes, we need to look at it from the employer perspective first this time around. So employer Nick, you may well have seen some commentary in the mainstream media about this and how it's all going to work. But I think a lot's been focused on who's going to pay it, who's not going to pay it. Unless you're a very, very small business, perhaps a husband and wife affair, maybe one or two staff, you have got a big tax rise coming. And I'm going to come on to some examples from that shortly. These big tax rises are coming through from April of next year. The two parts of it, threshold for paying employers Nick is reduced from £9,100 a year to £5,000, and the tax rate increases from 13.8 to 15%. Now, what does that mean? So the threshold reduction, so anyone you're paying more than £9,100 a year, you've immediately got a £615 increase to what it costs you to employ them. And another £300 if you've got a worker on 35,000. Now, the reason I've used that number is because apparently it's average earnings across the UK. So if you've got someone on an average earnings across the UK, you've got the best part of £1,000 extra cost for employing them. No pay rise for them, no happy employee because they've got a pay rise, just another £1,000 for the privilege of giving them a job. The small sweeteners, and this is why it's the smallest businesses don't see quite the same impact, is that the employment allowance, which is a nil rate of tax on the first, currently £5,000 of employer national insurance, has been raised to 10, or will be raised in April to 10,500. So for the very smallest businesses, that will get rid of some of the impacts of this change. And for those of you who have got a larger payroll and who might not be able to claim it currently because your employer's national insurance bill is over 100,000, that restriction is also being removed from April. I think that's something to do with state aid rather than the government suddenly discovering a love for businesses. So I'm going to move on to some examples here. Three hypothetical businesses here. The smallest one could be a small hospitality business. You've got a dozen staff, average salary or average earnings per year, 12,000. Now, that's because you've got a lot of part-timers. Someone on the minimum wage would be on considerably more than that. It's a lot of part-timers, but they're above 5,000, they're above 9,100 a year. So you're going to get hit by the national insurance increase and particularly the reduction in the threshold. So for this business, the threshold reduction costs them £7,380. The rate increase isn't so much because they're lower earning staff, but because it's a small business, the increase in the employment allowance actually takes away quite a lot of that. So for them, it's a 2,300 bill in round terms, 1.6% of salaries. So something to bear in mind, but probably not crippling when you sort of take into account the business environment. Yeah, you might struggle to put your prices up, but the minimum wage increase is probably going to be the bigger problem for that business. Interestingly, if that business were 10 times the size, because the employment allowance is such a small part of it to a much larger business with that cost base, let's say a care home or a bigger hospitality business, for that, those bigger businesses will see an increase 3-4% of their payroll quite easily. I've also then put two larger businesses on there just to give a bit more of an example. If you've got a pay run of around 1.3 million, so just over 100 grand a month, 40 odd staff, you could well be suffering an increase of 30,000 in your national insurance bill. So nearly 2.5%. Larger business, again, perhaps 100 staff, similar average salary actually, and this last one is someone we've actually done some numbers for. They're going to see a bill, an increase of nearly 79,000. So taking on 2.5 members of staff, or a 2.5% increase. Now, the thing to be really conscious of here, and the reason it's really worth doing your sums up front, is that this tax increase will hit you from May, when the April pay-as-you-earn deductions get paid in the middle of May. And it will actually be, for many businesses, far more significant than the increase in corporation tax from 19% to 25%, which took place last year, but due to the fact that corporation tax is paid in arrears, many people are only really seeing that now. So really do have a look at this in terms of the impact on your business. We can help with calculations so that you can sort of feed it into your thinking. For a lot of businesses as well, the minimum wage increase will be a headache if you're in sectors that have a lot of staff at or close to the minimum wage, because of that 6.7% increase that will again come through from the 1st of April 25. Now, what's also worth noting on this one is that the government appears to have made a tactical decision to try and phase out the discounted rates, certainly for 18 to 20-year-olds, and quite possibly also for apprentices and 16 to 17-year-olds. That's not clear from some of the communications that have come out. So I think for those who employ school leavers, you may well see significant ongoing increases over the next few years, and just something to perhaps bear in mind with your recruitment plans. So, possible consequences of the changes to your payroll costs, payroll tax liabilities. The government is hoping that you as business owners will swallow it. That's how they've costed it all. In practice, I doubt there are many business owners amongst you who plan to pay this purely through the business. Quite common tactics will be passing on some of the increase to your customers through price rises. In other words, it becomes inflationary. It's an expectation almost amongst a lot of commentators that employees, other than those on the minimum wage or close to it, will see lower pay rises in the next couple of years as a consequence of it. We've heard word that people are freezing their hiring plans. So rather than pay for that extra 2.5 members of staff, they just won't hire those members of staff. And also, I've heard of cases where people are now looking at automation of processes to take out the staff cost by reducing junior or unskilled labour. So lots to bear in mind. Start by doing your calculations, start by working out how much it will cost you, and then obviously plans will need to follow through from there. But for many businesses, if not most businesses, it will be a big tax hike.
This is something that we've already started to do for other clients as well, isn't it, Chris? So we know we've got some calculations ongoing at the moment. So you can end up with a double whammy hit, really, of the national minimum wage, and you've got the employers and our NICs going up as well. And then it's the possible consequences as well of the an increase in national minimum wage you have on the other staff as well, because if they've had an increase, so you want to see all the bands going up as well. So it's kind of affects everybody who's hiring people on minimum wage. So it is a bit of a kicker, that one.
Yeah, I think retail, hospitality, care home type sectors will be particularly hard hit. Anyone that has got a sizable business where you have a lot of staff at or close to the minimum wage, those are the businesses that are going to be hit hardest by the increase. But yeah, we are doing calculations for a number of clients already. So if we then move on to corporation tax, VAT and business rates, perhaps what we normally see as business taxation, this bit is the bit the government's put out as the positive. Here's our roadmap, here's what we're doing, and saying that actually we're not planning at the moment to put up corporation tax for the remainder of this Parliament. So the headline rate remains at 25%. The 19% is expected to remain in place for profits of less than 50,000, with a tapered rate between those numbers. Actually, with the high inflation of recent years and perhaps what we might expect from the inflationary aspects of the previous tax rise we've discussed, those numbers are becoming smaller and smaller each year. More and more people are going to be at 25%. The VAT registration threshold is going to remain at 90,000 and the deregistration threshold at 88. Then perhaps the other big kick for those in the hospitality, leisure and retail sectors is that those businesses have, since COVID, had enjoyed a 75% discount on business rates. That's going to be reduced to 40% from next April. So that's another bill coming for those in those sectors. Although the government has indicated that rather than this being looked at on a year-by-year basis, they're hoping to put some kind of a more permanent discount for certain businesses in those sectors going forward. So having covered business tax at quite a pace, we'll now move on to personal tax. Very much less to say here. The government's not done very much at all. Personal allowance remains at 12,570, where it's been for a few years. Same, the higher rate threshold at just over 50,000. The top rate threshold, if you recall, was reduced from 150 to 125 a year or two back, and that threshold remains in place, as does the tapering of the personal allowance for earnings above 100,000. Those allowances continue to be expected to remain frozen until 2028. So you've still got your rates effectively 20, 40, 60 between 100 and 125 before dropping down to 45% thereafter. No changes for tax rates, perhaps surprisingly, including for dividends. I think a lot of tax commentators had expected that one to go up and expect it may well go up next year. And it was just too much to put through at the moment. Pensions annual allowance of £60,000 remains unchanged, and they haven't brought back the lifetime allowance. I suspect that's got something to do with pay for senior members of the public sector, doctors in particular. It was increased because they were retiring. The lifetime allowance was causing problems with that group. I think that's probably why we haven't seen that being hit.
I think it's probably in the too difficult pile as well for them to actually bring it back in.
The lifetime allowance is in the too difficult pile because you make the doctors retire, you have taxation depending on who you are. So Mr. Smith pays at one rate because he works for a private company, and Mr. Jones lives next door on the same income, gets a completely different tax system because he works for someone else. It's not fair. And I think there is a realization that you can't really go down that route.
And the ultimate cynic in me says, well, the allowances remain frozen until 2028. Funny that, isn't it? Because that's just about, if I'm not mistaken, about a year before the next election. Well, anyway, remains to be seen. I'm not getting political on this.
We're trying to stay away from politics today, Stephen. I know it's a very political day, but we're trying to stay away from it. National insurance, again, no change. The government decided not to reverse the previous government's cut to employee rates of national insurance, so they remain 8% and 2%, and for self-employed 6 and 2%. So I've just got a brief slide on profit extraction because we regularly get asked, should I still be taking dividends or should I be switching to pay as you earn? And the reason we get asked that regularly is because the difference has really reduced in recent years. The calculation's actually quite complicated, and the tables on the right include the impact of employer national insurance. They include corporation tax at 25%, and they include income tax, whether that's on earned income, rental income, or on dividends. So because personal tax rates have remained completely unchanged and the corporation tax rate has remained unchanged, the effective tax rates, when you take all of income tax, national insurance, and corporation tax into account, remain the same if you're taking money out of a business through rent or interest or through dividends. And they also remain the same if you're a sole trader or a partner in a partnership. However, what you do see is the increase in national insurance contributions means that pay as you earn has become marginally more expensive, and you end up with a very small difference for higher and top rate taxpayers between pay as you earn and dividends. Dividends initially look slightly more expensive. However, what those tables don't take into account is the employment allowance, so the nil rate for the first 10,500 next year of employer national insurance contributions, the ability to keep cash in a company rather than if you're a partner or sole trader being taxed on it all the way through. The ability with dividends in particular to split income with a lower earning spouse. And also the fact that using dividends switches some of the tax benefits, so the tax burden into the company, which I'm not going to go into the detail of because it's complicated, but for a lot of people, the dividends remain the preferable option, and that's perhaps heightened slightly by the increase in employer national insurance contribution. So for most people, there's nothing in this budget that suggests you should switch to pay as you earn. However, the very smallest companies, so I'm thinking here your husband and wife type affairs, or one individual and someone else on the payroll. So anyone who's got 2 or more employees, but a very, very small wage bill. Those companies may well want to now switch to pay as you earn because the employment allowance is 10,500 from April, and because you need 2 employees to be able to claim it. That's why I say not just a one-man band. Those small businesses, the employment allowance will cover £70,000 of salaries, which would ordinarily be subject to employer's NIC. For those businesses, pay as you earn probably becomes cheaper. So it may well be that if you've got a husband and wife consultancy, let's have the wife out as the consultant. She could may well be preferable for her to take 50,000 in pay as you earn, and for the husband who's got another job somewhere else to be taking a 10,000 salary to make sure the employment allowance is available. Those are the sorts of situations we perhaps look at on a case-by-case basis, but for most people, the budget doesn't change the analysis. So
just interrupt. We just have one quick question on that. So does the NI change mean that for sole owner businesses, they'll be better reducing salary further and taking more in dividends? My guess is for that is if you're a sole owner, if it's a sole owner business.
Yes. However, what you'd need to bear in mind is that you will, I think it's currently about £6,500 you need to pay yourself a year to be deemed to have paid national insurance as an individual for the year for state pension purposes. So you're not going to get rich either way on whether you go for a 10,000 or an 8,000 or a 6,000 salary, but I would just double check what that figure is for 2025 before reducing yourself to 5,000.
And then again, for sole owner businesses, it's a question if you can get somebody else onto the payroll, even if it's part-time, to be able then to obtain the employer's allowance.
Yes. Yeah. So moving on from that one to the next pane in the budget, capital gains tax. I'm assuming that most business owners will at some point either want to pass on their business or to sell it and to realise the value in it. There's quite a lot of bad news here. If you sell a business and beyond the first million, you've already got a tax rate increase from 20 to 24%. That came in as of last Wednesday. Interestingly, I've had come across a couple of people who sold businesses or sold shareholdings in businesses on Wednesday and are now going, oh, I thought it was only applicable from Thursday. No, if you've done something on budget day, the change was retrospective by a few hours. So anything that happened on Wednesday is subject to the new rates. That's an increase in the capital gains tax rate for sales of land, commercial property and shares. And to be honest, anything else other than residential property. The annual exemption remains at 3,000. The other pain as business owners that's coming through is business asset disposal relief or taper relief. Entrepreneurs relief, as it has been known in the past, which has given people a 10% tax rate for the last, in various guises, 25 years. That's going from April. The rate's going up to 14%, and then it's going up to 18% from April 2026. So currently worth £100,000. Oh, sorry, it's actually worth £140,000 between now and April. But the tax rate's going up from April, and by April 26, that allowance is only going to be worth £60,000. Whether 18% is a permanent fixture or whether it's going in its entirety, I don't know. There's no change at the moment to the lifetime allowance. It's still £1 million. So, inheritance tax. You can't take it if you don't manage to sell it and you've still got the asset when you die, or you've got some other assets when you die. More bad news. The nil rate band is going to be frozen until 325,000 until 2030. So that's 2 years beyond when they've announced they're freezing all other allowances until. And it's been at that level, interesting, since 2009. So but by 2030, 21 years, that will have remained at the same level. The residence nil rate bands will also remain frozen at 175,000 until that time, as does the taper for the residence bands, which is when that starts to get withdrawn. So if your estate's over 2 million, you start to lose the residence nil rate band. That threshold is also remaining in place until 2030. So they're really pulling more in through freezing allowances there. However, that's not the real problem for business owners. The two real problems that come out on inheritance tax are the partial withdrawal of agricultural and business property reliefs. The media seems to have picked up on this in relation to farms. it has much broader application because business property relief is also caught. What the change is at the moment, if you leave assets that qualify for either agricultural or business property relief, is 100% relief from inheritance tax. In other words, no tax is payable. What assets qualify? Well, business property relief, if you have a business, a trading business, I'll clarify that. So a trading business, any shares in that business, or if you operate through a partnership, you're interested in that partnership, your sole trader business, that qualifies in principle for business property relief, as long as it's not investment assets in there. So at the moment, you've got a nice trading business, you get knocked down, your heirs inherit that, no tax, not a problem. That changes in April 2026. Going back to what qualifies, agricultural property is farm houses if you're a farmer, farm buildings if you're a farmer, and farmland if you're a farmer, or if you've owned it for a longer period of time if you're not a farmer. So the problem for farmers, and it's particularly acute for them, and that's why the media's picked up on it, is that they typically have all of their assets in the business. So farmer dies, the farm's maybe 100 acres of land, all intensively farmed, there's no assets or minimal assets outside of it. Suddenly, after the first million, and agricultural land is probably quite easily 12,000 an acre, plus the value of the house, plus the value of the machinery, there's going to be a big tax bill, 20% tax on the value over £1 million. That farm either has to sell land or be broken up, sell machinery, just because someone's died. Now, that might be as an accident. They might even have been murdered, but they've still got that bill. Similarly, for businesses, it's if you've got, other than a small business, you could well be impacted as well. An awful lot of businesses we deal with, if we actually valued them, they would be worth more than £1 million. So that business, if you died unexpectedly, there's going to be an inheritance tax bill from April 2026 that's not there already. Now, who's like to be affected particularly? It's going to be the larger businesses, but a large business where most of your assets are in the business. So classic example would be someone who's got a very nice business, might be worth 5 or 10 million, but still lives in a small house and has reinvested all of their profits in the business. If that individual died unexpectedly, I'm working on unexpected deaths here rather than someone who's spent their later years planning, there's suddenly a huge tax bill. How is your estate going to deal with that? What does your will look like? Do you need to reconsider your will? So a lot of business owners now need to be thinking, how would a tax liability be managed in the event of an unexpected death? The only saving grace here is we've got 18 months to decide how that might be done. I can see a lot of people looking at insurance arrangements. I can see a lot of older business owners looking at trying to move assets on to the next generation in the hope of surviving 7 years. But each situation is going to be different. And it's the sort of thing that is going to need both accountancy and tax input, but quite often also a financial advisor's input. Don't rush. Defined contributions pensions. So unspent pension pots will form part of a deceased estate from April 2027. So 2.5 years off. At the moment, if you die, your pension pot is almost certainly outside your estate. In that means your heirs can inherit it without paying any inheritance tax. Now, for most people die over the age of 75. Their heirs will pay income tax when they take the money out of the pension, so it gets taxed at some point. For those who die under the age of 75, the money can come out completely tax-free. Now, there would appear to be no grandfathering of pensions brought up under the old rules. So there doesn't appear to be anything that says if your pension pot was £500,000 at 30th of October 2024, that amount stays outside and anything after that date comes in. That's different to how they've changed pensions allowances in the past, where they've grandfathered people who've already had a higher allowance. So, for example, when the lifetime allowance was reduced in the 2010s, people who had a higher allowance were allowed to retain that higher allowance. So in a lot of ways, that would appear to be, and there's an element of retrospection in that taxation. On top of that, as things stand at the moment, we understand that inheritance tax will be charged on the pot. And then when you take the money out of it, or should I say your heirs take the money out of it, they're going to be charged income tax as well. So there's some double taxation in that, by design rather than by accident of the rules. So at the moment, there's a consultation out with the pension companies to how it works in practice, how it sits in with the probate rules, and the probates, how you manage probate, how you manage wills, and how the inheritance tax gets paid. So I think what that does is it probably massively changes how pensions might be used by those outside the public sector. Public sector, of course, got defined benefit contribution pensions, not defined contributions. So their pensions die with them, they're unaffected. That's something that those who are likely to be impacted, in other words, those who expect to leave a pension pot when they die, need to be reviewing in conjunction with the financial advisors. Equally, those who have been saving as part of a inheritance tax structure, again, that needs to be reviewed. What do you want going forward? How do you want to manage it? One possibility might be making lifetime withdrawals. Yes, you're subject to income tax and then gifting your surplus income, because at the moment, those gifts out of surplus income are immediately exempt from inheritance tax. So essentially, you're putting pension, you pull the money out of your pension, what's left after tax you give to your heirs, and your heirs may well then be able to make pension contributions themselves as a way to wash it across the generations. Something to consider, but again, don't rush, because a lot of people rushed pre-budget, we understand, and have regretted decisions they've made in terms of what they've done with pension planning, because they acted on rumours and things like that. So it's something to consider. It's 2.5 years till it comes in. I think that's mainly due to the need to actually get a process that works in practice, but it also gives you time to think about how things might be managed.
But again, don't forget you've still got the 7-year gifting rule as well. So if you did want to make lifetime withdrawals or draw money out of the pension pot and gift it to children or whatever, then survive the 7 years, then it still doesn't form part of your estate.
Yeah, that's for lump sums. Obviously, if you did an amount every year and did regular gift out of income, that's immediately exempt. There's two different gifting allowances or rules within the inheritance tax. Okay, so I'll now move on to just some of the other tax changes which you may or may not have seen. The first one is furnished holiday lets. Now, this was actually announced by the previous government, and it's now been confirmed that it is going ahead as of 6th of April next year. At the moment, furnished holiday lets benefit from a more generous tax regime as regards income tax and as regards capital gains tax. That disappears from the 6th of April, and furnished holiday lets will be treated in exactly the same way as other residential lettings. Now, the big change for most people who've gone into holiday lets is that their mortgage interest will be restricted in the same way that it is for other residential property income. So you add it back and you get a relief off your tax bill of 20% of the mortgage interest. Whereas at the moment, if you've got a holiday let, you can deduct the mortgage interest off in its entirety. So for higher rate taxpayers, which is probably the majority of holiday let owners, and with inflation in recent years, increasingly more and more people are higher rate taxpayers, that is a real cost to you. Equally, I'm conscious that a lot of furnished holiday let owners might have a rental portfolio as well, but they use the holiday let income to make pension contributions. That stops from April because it's treated as other residential income. And the other thing is when you come to sell it, in many cases at the moment, you've got business asset disposal relief on the gain, so 10% tax. That disappears as well in April. You'd be at 24% tax, so the same as other residential properties. The last one on that list around the changes to claiming tax relief on expenditure on fixtures, furnishings, etc. In practice, the move from capital allowances to renewals basis will delay when you can claim relief for that expenditure. So that's furnished holiday lets. And then perhaps some of the other things that have been slipped in there. Double cab pickup trucks. At the moment, for VAT purposes and for benefit in kind purposes, they're treated, as long as the payload's over a tonne, as if they're a van, which means you can get the VAT back because it's a van, and the benefit in kind is small because it's a commercial vehicle. That's changing from April, and for benefit in kind tax purposes, they're going to be taxed as cars. They have decided to grandfather that for those leases and purchases that have already been made for, I think it's 4 years. So if you've got one at the moment, you don't need to immediately get rid of it to avoid the tax bill. But going forward, there's going to be an enormous benefit in kind charge on these things because they have big engines. So the benefit in kind tax is big on them. Hybrid cars. Many people who don't want to go wholly electric because they don't want to be reliant on the charging infrastructure, they do long journeys and don't want to have to wait for long periods of time to refuel, etc. I've gone for hybrid cars. From a benefit in kind perspective, for the last few years, they've been okay, not been too bad. However, from 2028, the benefit in kind tax on those goes up dramatically, and they'll be taxed in the same way as conventionally fueled cars. Benefit in kind is going up on zero emissions cars to electric cars slowly and more quickly from 2025, but there is a very big increase coming on your hybrid cars in 2028. If you do have a company car, that's the most common benefit in kind we see, that and private medical. From April 2026, you're going to pay tax on it through payroll. What that means in practice is, apart from a headache for us in trying to process it and a need for you to actually tell us that you've taken the private medical or the car up front, I don't think the revenue understands how a lot of small businesses work in practice, is that you pay 2 years tax in one on the year of transition. Anyone who's looking to buy a second home, a holiday home, or a buy-to-let property, whether in a company or personally, you'll find the supplement's gone up from 3% to 5% already. If you pay your tax late, the interest rate, which is currently base rate plus 2.5%, is going to go up by 1.5% to base rate plus 4%. Interestingly, the revenue aren't going to pay more interest when they delay your repayment for whatever unknown reason. I think what we can take into consideration there, for most people, it's income tax, self-assessment, that's the big one there. It's just another incentive to get your information to us early so that you don't get your tax bill on the 31st of January. And if it's unexpected, you've not got the cash. 7.5% interest is bad enough. do you really want to be paying 9% interest? And then another one, the previous government announced a plan to try and put the child benefit charge onto a household basis. This was to try and correct the unfairness in there, that you could have one household where both earn 60,000 and they get full child benefit, whereas the next house has one earner on 80,000 and that's it, and that second house gets no child benefit. So the second house, let's say it's Mrs. Jones, she's the sole parent, so she gets no child benefit, household income 80,000. Next door, Mr. and Mrs. Smith, both earn 60,000, so total income 120, full child benefit. I think it was always difficult, but strangely the current government abandoned it on the basis that it would be unfair to single parents to try and put it on a household basis. Don't know how that fits with the analogy I've just given you, but that's the justification given. I haven't mentioned some of the other things like VAT on school fees. They're in the media. Stamp duty, land tax threshold, similarly coming down. It's in the media. There's not really something that I can add for what I'm assuming is mostly business owners who are viewing this webinar. So at that point, I'll come on to the next webinar, which for those of you who are business owners is the next instalment of problems, the new employment laws and how this will affect you. And we've lined up Emma Fay from HR department in Winslow, who is, what would we call her, Steve? An employment specialist.
Employment specialist, yeah, very much so. She's got a great reputation. It's well worth listening to. So she will update you on all the stuff that you do need to know. As you can see, everybody, there's a lot in this session, and we can make these slides available to you if you want them. There will be a recording which is up on YouTube later on today as well. If anybody's got any questions, we're around for the next 10 minutes or so. If anybody wants to unmute yourself, feel free to do so, just shout out. Or if you want to stick a question in the chat box, it's kind of a rapid review of the budget. We do appreciate that there are things in there as well. I know school fees for some of our watchers and listeners today is a big issue, but there are also opportunities there. It's well worth having a look. So if certainly in the school area, if you want to get in touch with us, that's fine. Get in touch with us. That's no problem at all. What I will do now is I will close the meeting, but we'll stay online. So the recording will stop. You can stay online and you can ask any questions that you like. So thank you very much indeed for joining us. Don't forget, we have our business lunch on the 20th of November at Holland Hall Hotel in Bollington. And then on the 27th of November, again, we've got MFA joining us. So it's well worth booking yourself on from those, and you can do that from our events page on our website. So feel free to go there and have a look. So again, thanks very much for joining us. I'm going to stop the recording now,